Navalbir Kumar of IDFC Asset Management, he holds, however, a skeptical view on the markets. He believes that there is no solid data to suggest that the economy has bottomed out. In an exclusive chat with Nikunj, he also insisted that it's a stock picker's market and that a secular rally is yet to materialize.
There is no clear indication that tells us that GDP has bottomed out. The fact that inflation has peaked could be right, because you're seeing commodity prices ease globally. To some extent, they're not rising anymore, and you are clearly seeing pricing capacity in the manufacturing sector in India erode. So hence, manufacturing inflation is coming down. So inflationary pressures are easing, but consumer prices are still high. And you must remember that in the WPI number, which came sub 5, three key items, which are electricity, coal and diesel, haven't been updated now for quite a considerable period of time. So inflation is a little understated today in WPI than it truly is.
Many experts, however, are of the view that worst of the macro is behind us because globally commodity prices have corrected. If commodity prices, they will correct further. It is fantastic news for our macro.
You're right, in the sense that for the growth in India is driven predominantly by the investment economy. Having said that, over the last 5 years, as the size of the middle class has grown, consumption is now starting to add to the GDP growth rate. And the current driver for growth is the consumption sector. For the investment economy to restart, you need two things. One is you need capital efficiency to improve. So assets that were put on the ground in the last investment cycle have to become productive. So a lot of issues around coal, land, environment need to be cleared. Second, you need cost of production to come down. So for the next wave of investment to happen, you need land prices, cost of money, commodities, and cost of labor to ease. And frankly, the liquidity in the environment created by the developed economies is ensuring that asset prices are remaining fairly firm. So they are trying to boost their growth rates through consumption, through creating a wealth effect in the economy. Unfortunately, the same wealth effect is keeping cost of production in developing economies and inflation high. So hence, for the next investment cycle to start in countries like India becomes that much harder.
And do you think the real investment cycle will only start after the outcome of general election? Because it's highly unlikely that growth capital will come back before this big event.
I think foreign capital flowing into India is not really a concern. I think foreign capital is still fairly robust, which is why we are being able to fund a very large current account deficit. Keeps RBI nervous, quite correctly so, but at least is being funded. I think what the next elections may do from a growth trigger perspective is twofold. One is if the new government that comes in can ease capital efficiency, like I said, that itself would be a trigger to growth, because it will create a lot of supply in the Indian economy if you ease a lot of policy issues that currently exist. The second is if the new government that comes into power changes the direction of the fiscal deficit away from social spending and towards infrastructure development, towards the investment economy, and also reduces the size of the fiscal deficit, I think that will be the second trigger to growth. We don't see the current government either changing the direction on fiscal, and especially being an election year, we think that is difficult. Second, we are not seeing sufficient progress being made, though we do hear and efforts are being made to improve capital efficiency. A significant development is not happening on that front. So I think the aspiration or the expectation from the new government is on these two counts from an economic growth perspective. So those will be the triggers in my view.
So are you making a case that we are currently stuck between rock and a hard surface? One side you've got consumption, which is slowing down. Other side you've got capital formation, which is at its lowest level in the last 10 years.
Yes, because I think RBI says it quite well when they say that you've got an untenable position with high inflation, a high current account deficit, you're hostage to capital flows, and the directional spend on fiscal deficit is incorrect because it further fuels inflationary pressures in the economy and does nothing to meet the supply side requirements. It is not increasing supply. It's not bringing factors of production into play. So it's not unlocking value for growth in the future. So direct transfers of cash, all they do is lead to consumption, and they really don't have a impact on improving growth. So if you were using the same fiscal deficit to either improve quality of agriculture, so hence you're improving GDP, you're increasing revenue, or you're putting up plant and machinery, or you're making labor far more productive, then all of them have a positive GDP impact because they have an ability to generate revenue and hence improve taxation and have a virtuous cycle. But the current direction of fiscal spending towards social spending is not causing that virtuous cycle of growth, and which is the big concern from Reserve Bank's perspective on monetary policy today.
A word on currency. Many experts also argue that the free fall in Indian rupee of late is a function of strength in the dollar index. Do you concur that view?
I think it's twofold. I think clearly it is an element of dollar strengthening, but also it's an element of a high current account deficit. So like I said, we are hostage to capital flows. We have done well in being able to attract large amounts of debt capital into the Indian economy, but that itself puts you on a treadmill. So a lot of that is short-dated debt, and hence you have to continue to be able to raise additional capital to fund redemptions and to bridge the current account deficit. So I think the rupee remains under pressure unless we get a trade account in control. And we are looking forward to the trade number, but nothing tells us that the trade account is shrinking.
You know, it's quite ironical and quite contrasting if I think about it. Foreigners are investing in Indian equities, domestic investors are not. Indian entrepreneurs are not investing in their own economy, but MNC companies are, Unilever, Crisil, Glaxo. So quite a contrasting picture.
Yeah, I think the big difference is between institutional and retail lending. So frankly, we believe that you should buy into equities whenever the price risk is low, and currently price risk in Indian equities is definitely low. It is.
We had 14 times, so valuations are not very attractive.
It's not very attractive, but from historic perspectives, in bull markets when it has gone up to 18, 19 times, it's significantly lower than that. So there is a concern of earnings growth, but we are an economy, if you get a few things right, that will go back into the growth path. So this is a good time to buy equities. But unfortunately, the Indian equity markets get invested in predominantly by retail investors. There are very few institutional aggregators like pensions and insurance companies that invest aggressively in the equity markets. So, and retail investors are hard-coded to invest directionally with equities. And you have seen in the past that whenever the markets do well is when they pile into equities, which is the wrong time to invest. And whenever you have an environment like you have today, when price risk is relatively low, but there are risks in the economy, they stay away. The international investor is predominantly, the aggregator is an institutional investor. So he aggregates on a monthly basis. He needs to deploy that capital on a monthly basis. India clearly, because of its growth dynamics, has now a permanent allocation in most people's portfolios. That allocation can be overweighted or underweighted.
That's a risk also.
That's a risk. But given the fact that I think India has emerged, so I would be very surprised if Indian allocation goes to zero. So maximum will be underweighted or overweighted. So since they get monthly flows, they continue to invest in the Indian economy.
Value is not making money. Consumer stocks are making money, but consumer stocks are expensive. Markets are getting polarized. Everybody wants to be with a clutch of 10, 15 stocks. If you're in that stock, you're making money. If you're not owning those stocks, you're suffering.
Which is true. So at this point of time, conviction will come from individual stock ideas. So sectors that are doing well, which are consumption sectors, which, like you mentioned, are beginning to slow, price has grown much faster than earnings. And hence, you're always wondering as to how much price can continue to run up. But if you're not in those sectors and you're not in those stocks, you don't participate in the rally. But you always, every day that stock rallies, it worries you because it becomes that much more expensive. The rest of the economy, the deep cyclicals, are going through a tough period. The defensive parts of the economy continue to do well, but they are priced, for example, pharma, and there's limited conviction in outsourcing right now. So hence, to find sectoral or secular ideas in the Indian economy today become tougher with conviction. So either you got price risk or you got earnings risk. On the other hand, there are individual stocks. What tends to happen in an economy or in a market like now is you get polarization of capital. So you've got the large caps that have done well because of capital flows externally, and a number of smaller companies in India have got completely bashed. They are much more difficult to invest in. They have very unique risk parameters, and there are a huge number of stocks in India today which seem to be doing well and have zero price risk. They're trading at between 2 to 8 times earnings. They have very low leverage, but they are small, so their ability to absorb a large amount of capital today is also much lesser. So this is a stock picking environment. This is not a secular trend picking environment in the Indian equity markets, but that's how the markets evolve. So they will move from stock picking to secular trend if we believe that some of the changes that should happen will happen with the next elections.